Yeah, madam, tell me, no problem. Yeah, it's fine, it's fine. At least you have put effort to have that document to read with you. And I appreciate her also, getting help from ChatGPT. So, Madam GPT. So, yes, read out.
The carrying amount is the amount at which an asset recognized after deducting any accumulated depreciation.
Only that or another sentence is there?
There is
Continue reading that.
depreciation and accumulated impairment losses.
I wanted to hear that also. See, now when you have an asset, let's say the cost of the asset, $1 million. Huh? Atan, so we are waiting from the door, you didn't come, so we are very upset. 1 million estimated useful economic lifetime. Yeah. Let's say 5 years. And we follow straight line method depreciation. And if we follow straight line method depreciation, and we now 3 years finished. Yeah, 60% or 3 years finished. Now, what could be the accumulated depreciation so far? What could be the accumulated depreciation so far? 600,000. Understood the calculation? Mr. Mansoor, no? He's very old person to me. Yes. He is old also. No, he is not old. Yes. Yes. So 1 million, you divide this by 5, and we said that 3 years over, and you multiply this by 3, you get 600,000. Now to calculate carrying amount, we also have other names, net book value, or sometimes we also call it book value, is equal to cost minus accumulated depreciation. As per the definition, that also include as per the definition, this also includes accumulated impairment losses. This should be the calculation. But for this example, we don't have impairment loss. So therefore, your answer will be 1 million minus 600,000. You get 400,000. So one of the term that is important in IAS 36 is carrying amount. Is clear now? Second term would be value in use. I had a very interesting exercise during the last few days to calculate value in use for a restaurant. Restaurant, they have different equipments. They have kitchen equipments, they have furniture, they have all these infrastructure related equipments, everything. What they're saying is, give us a value based on value in use. Now the issue is, okay, let's try to understand what is value in use first. This particular assets This particular asset's value in use, carrying amount is 400,000. Now, if you see the timeline, so 1 year is finished, year 2 also finished, year 3 also finished. We are now here. Now, what do you mean by the value in use? The standard says that the present value of future cash flow that could be generated by using these assets for the remaining period of the time. This is not the depreciation. What they want is to know, now suppose for using this particular assets, every year, example, every year you generate 300,000 dollars. Every year how much you generate? $300,000. Now I am here, this point, meaning at that point I have to consider myself now. Now meaning in terms of years, now is year 0. And this will be 1 and this will be 2. So see, also remember, sometimes people make assumptions. Cash flows occurs at the beginning of the year or at the end of the year. Here I am making the assumption cash flows occurs at the end of the year. So for this time zone, on this date, if suppose this is 2019, this will be 31st December 2019 or 1 January 2020. By that time, I have generated a cash flow of how much? 300,000. So years 0, 1 and 2. No cash flow here. And here how much? 300,000. For the sake of simplicity, year 2 also, I have 300,000. Now what they're saying is, you need to calculate the present value of the future estimated cash flow that you would generate because you are using that assets. So now to work out and calculate the present value, I had to make an assumption. All of you know the concept of present value, or you want me to elaborate?
Time value of money.
So we talked about
Time value.
time value of money.